Welcome back. You're watching Business Morning on Channels Television. Now, more banks have been turning in their 2015 full-year results in the Nigerian Stock Exchange. And, of course, investors have been digesting these numbers and reacting accordingly. Now, some of the banks that have turned in, Guaranty Trust Bank turned in its result yesterday. Zenith Bank as well. No, 2 days ago, the Zenith Bank and UBA turned in their result yesterday. So we're taking a look at UBA's result for the full year ended 2015. We saw gross earnings for the group up about 9.8% to 314.83 billion naira. Profit for the period was 59.65 billion naira. They had a basic earnings per share of 179 kobo. They're proposing a dividend of 40 kobo. Total dividend proposed is 60 kobo. So we're taking a look at these numbers with the Group Chief Financial Officer, beg your pardon, of UBA, Mr. Ugo Nwawudu. Thank you so much for joining me on the program this morning. Good morning.
Thank you. Good morning.
So 2015 was a very challenging year, not just for the banks, but for the economy as a whole. And UBA still managed to beat expectations. Looking at your earnings, what are the underlying drivers?
Well, okay, the key drivers are as follows. First, during the year 2015, we embarked on repricing of our interest-earning assets, and that's helped significantly to grow the interest income. You'll notice that interest income grew about some 37 billion, from 197 in the previous year to 234 billion in 2015. Part of the things we also did was to realign the assets on the balance sheets, basically achieving balance sheet optimization by moving assets from lower yielding buckets into higher yielding buckets as well. Some of the other factors also include the fact that we had significant some level of savings from interest expense drop, largely in the last quarter. I think that was also very helpful. You'll notice that interest expense grew only 6%, whilst interest income grew some 19%. Mm-hmm. That was also contributory. One of the other factors was also the fact that from Africa, we saw significant improvement in performance in a number of countries in Africa. We saw countries like Congo Brazzaville, Cote d'Ivoire, Senegal, Guinea, coming with very strong double-digit growth in profits. So that was those were the key factors driving this, and of course the normal cost efficiencies that is a standard part of our operation. Oh
yes, but then you should also not forget that last year most banks were not insulated from heavy non-performing loans, but somehow UBA's non-performing loan ratio stabilized at 1.7% with a modest cost risk of 0.5%. How did the group achieve this, especially since, as I said, there was a heavy non-performing loan percentage for 2015?
Yeah, okay. I think that's a good point, and you're right in noting that we have a good NPL level. NPLs at 1.7% is a very good one. And I think the key drivers are as follows. If you maintain a very prudent approach to credit underwriting, you certainly will derive those kind of benefits. For instance, you start with ensuring that the sectors and segments of the market you play in are carefully selected, and this is what we actually do. We ensure that we're not exposed to the rather very volatile segments of the market in terms of credit. How are you doing that? We do that by setting criteria, risk acceptance criteria, and industry sector limits, and we select sectors in different markets. We operate in several countries across Africa, so we look at those markets, we identify sectors that drive the economy, and we identify the potential vulnerabilities in each of those sectors, and then we put that side by side our risk acceptance criteria, and then we position where in those sectors we're going to play, which subsector. In certain sectors we don't play in some subsectors within those sectors. For instance, if we play in oil and gas, we are very reserved in most markets around the downstream. There are certain subsectors that we will not play in. So you just look at the different sectors and segments, customer segments as well. In some areas you focus much more on the corporate end of the market, and in some other markets you just don't go to certain segments. So it's that careful selection of which segments and sectors you play is a fundamental factor. And the next thing is obligor risk acceptance criteria is also key. After you've determined the sectors and the segments you want to play, you carefully select your obligors. So there are obligors that will come your way, and you just say no when you do certain checks.
So you're more you're selective in terms of being more corporate focused than individual focused, or even growing the real sector. That's what it seems.
No, we focus on the, like I said to you, we focus in most of our markets. You find our portfolio is focused on the key drivers of the economy. Okay, so we look at those sectors that drive the economy, we focus in those sectors. You are very careful in selecting the customers, and you are very careful in how you lend to certain subsectors within different segments. So clearly you support the real sector. There's no way you can focus on industry sectors that drive economies and you're not helping the real sector. So you focus on the real sector, but you make sure that you're particularly very careful about what obligors within those sectors that you want to play with. And also, a very critical point in that is also ensuring that when you structure the credits are properly structured, because that's where you start to get it wrong. And finally, you focus very much on intensive credit monitoring. After you've written the credits, you monitor them, stay close to the customers. You are then able to identify early warning signs so that you can take steps to address them.
And mitigate the amount of money you lose.
And mitigate the amount of money. And more importantly, you monitor global and domestic economies to understand how changes will potentially affect your portfolio, so that you can defensively position your portfolio to ensure that that you're able to take care of the vulnerabilities ahead.
Well, quickly comment on this if you can, so that we can squeeze in as much as we can in this short time. A number of listed lenders are giving profit warnings on their 2015 earnings. Are there reasons for investors to, for now, start to worry about the health of banks?
Well, I'll say in terms of profit warnings, I think the thing is it's just becoming it's just for the first time that people are really beginning to realize that there's a responsibility to the investment community. If you think your profits are going to come significantly short of what you've advised or expectations, it's important and that you actually advise the investment community. And that's why, I think for me, it's a stage of development in our overall reporting and corporate governance environment. So I don't think there's much cause for worry. It's just that perhaps a number of the banks may have been a bit over-optimistic about 2015, and things haven't quite went the way they expect. But overall, I think the industry still remains very strong, and the signs are there. You've seen the results of the first banks that have come out. The first 3 banks or so that have come out, the results have been very brilliant. And so, for me, there's nothing to worry about in the industry. A few pockets of disappointing results might result in profit warnings, but that doesn't mean that the industry is in trouble.
So that's your outlook for 2016. It's a positive outlook for 2016. Yeah,
obviously, 2016 is going to be an interesting year. I think that whilst we've heard a lot of people talk about challenges ahead, what we see are opportunities that those challenges come with. So what we are looking at is just focusing on those opportunities and turning them to good returns for our shareholders.
Well, thank you so much, Ugo Wabodo, for coming on the program this morning.